Whenever you're starting a business, one of the first things you have to figure out is what makes you different from your competitors. And that is also one of the most common asked questions you will get, and it's also one of the most common questions we get. So for today, we're gonna go over what we believe our strategic advantage is for Commune Capital and how that separates us from other firms. So Mikey, why don't we go straight into what makes us different?
It's a good question. A lot of groups like ours in this space will throw out a term pretty much across the board, which is we underwrite deals conservatively. And that sounds really good. And as you're looking at a deal, you want to work with the group that looks at deals with kind of a worst case scenario lens as a potential. But to just say we underwrite conservatively is not enough. You really have to understand, what does that actually mean? How are you underwriting conservatively? What does it look like if a deal doesn't come to fruition? Because the one absolute reality we know to be true in real estate, at least with our experience, nothing ever goes to plan. And so you will face adversity in a deal that you do. What adversity you face depends on the circumstance of the deal itself, but something will happen. You'll either have a delay in your construction, your costs will go overboard, whatever the case may be. And so how we look through the lens of real estate is through that, is what adversity can this project bring? And if that happens, what actually happens to the project?
So why don't you walk everyone through a deal that we've actually done and show them our stress test model, and when you talk about adversity, what type of adversity we throw at a project?
Sure, so the deal that we'll look at is the deal that we did in Ventura in July of 2022. It's the one that's on Front Street, and in terms of where we're at on that deal right now, we're still pre-construction, so we're still living in the world of the assumptive model that we built out. It's not a project that came full circle, but it's one that I think will help the viewers understand how you want to look at deals and what elements have to go into it. And so on Ventura, if we open this up, we have all of our assumptions table here that basically walks through all the critical parts of the deal. And then your various tabs on this spreadsheet are where the summary information is derived from. With respect to the stress test model itself, we have right here our sensitivity analysis. So where we want to start with is what is the net to investor IRR on the project. So as you can see, there's a lot of elements called base case, base case, base case. Base case is what the expectation is, which is already a relatively conservative view that we look at the real estate, but this is what we think is realistic. It's not ambitious, it's not ideal, it's realistic. So all the elements are set to base case with the exception of rent and revenue growth and exit cap rate. Our rent and revenue growth and exit cap, we put CoStar data in there, and CoStar is the service that we use that has actual economists that look in each specific submarket, and they come up with a 10-year outlook on what these rates will be based on economic growth, influx in the market, average income. They have a whole slew of variables that they look at. And so their data is actually a lot more accurate in our opinion than just throwing out a basic assumption. But we've also included basic assumptions that we can kind of play with the levers on these things. And so with each project, we effectively say, what are the elements on this specific project that could potentially cause a delay or go sideways on us? And they're not the same for every single project. We have some of the consistent ones across all of them, but then certain projects take on some unique ones, like permanent financing for Ventura would be one of them. So with respect to the pro forma, we basically underwrote this thing. We have our income assumptions that start once the project is stabilized. We have our construction schedule that we're looking at. We have our expenses here, and then we basically have our operating summary, which summarizes all the data that you just saw above. And then that runs through all the way through basically a sale assumption. So we also look at what would the project look like on a sale any year after stabilization, because if you sell the project right when it's done and stabilized, you're going to get the highest return as a percentage versus if you hold it. But as we'll talk about in one of the stress tests, we have to look at what would it be in the most ideal scenario and what happens if we can't sell it in the most ideal scenario and we have to hold it for longer. So we'll talk through that as well. And then we basically have kind of the IRR calculations that we work through. So With all that said, we underwrote this project, and in a base case scenario, it came out to a 20.3 IRR. So the first thing I guess we can talk through is this construction timeline. So in this specific project, if I go to this tab, which shows you your month-to-month activity all the way through stabilization. So we look at data on a month-by-month basis, going all the way through basically at least 1 full year of stabilization. And so on Ventura, you'll see that there's no revenue data. This is all revenue line items. There are no revenue data illustrated on here until month 37 or year 4, because this is a project that we closed in July. It's got about a year and a half of pre-construction work and then a 2-year construction window. And so our assumption here is month 37, we'll start generating actual income on this. So the first thing we say is, well, what happens if construction takes longer than the assumptive timeline? So when we stress this, we notice that instead of month 37, now month 37 shows no values of income at all. It's all zeroed out, and actual income gets pushed out until month 43. And so by doing so, the return on the investment is impacted, not significantly, but there is an impact there. So in this example, on our base case model, our return of 20.3 gets reduced to 18.2. And so that's indicative of the fact that something as small as a 6-month delay in construction could actually affect your returns. And that's something that happens relatively often. I mean, construction delays are a very well-known thing in development. And so when we look at a 24-month roughly project in terms of building, a 6-month contingency on that is not unrealistic to look at. So then we go into, okay, well, we know what happens if construction goes over in terms of time, but what happens if it goes over in terms of cost as well? And so in our budget, we actually have a contingency factor here of about $2 million, which means we've already accounted for $2 million of money that we don't know what it's going to go to, but we know that there are items in the budget that are going to go over, and we have this pool of reserves that we're going to pull. But then we say, well, what if it's more than that? So then we do the stress test on our construction cost, and we effectively find that now our sources and uses is off here because we need to bring more capital to the table. So we haven't brought that extra capital in the stress test yet, but we know that there's a potential we have to. So in this example, we know that our now overage is $578,000. So instead of bringing in the 575, I have to bring in that plus 578,965. That sets my sources and uses of the $38 million equal to one another. So now I'm in balance, and I see that because of the added capital I had to bring to the project, my return went from 20.3 to 19%. So we've solved for 2 of the main things that can happen during the construction period, which is overage in time and overage in cost. If they both happen, then we also can answer what happens if both of those things take place, right? So then the return goes down to 17.1, which is still, you know, in our opinion, at least a positive return to have. That gives us more confidence that we're starting to like this deal. Then we get into the other levels that we stress. So I'm just going to actually reset this. So now we're back to our base case of 20.3. So we went through the construction timeline, we went through the construction costs, and now we go into, let's say, lease up. So once the project is actually built and we're starting to lease the property, we have a forecast of how long it'll take us to go from fully vacant to fully stabilized. So as you can see here, there's a vacancy rate factor that starts at 100%, right before we complete the construction and start leasing up. And then you see this declining scale, basically each month, all the way to getting to a point where it's 5%, which would be a fully stabilized project. So in this example, in our base case, fully stabilized takes us 9 months. The question that we ask is, well, what if it takes longer to lease it up? What if, you know, the economy is hurting a little bit, it takes a little bit longer, whatever the case may be. Even though we don't have much confidence that, or have much concern that that's going to happen in Ventura, given the lack of supply in that market, it is a reality that maybe it takes longer than expected. So we look at it and we say, okay, well, if lease up takes us longer and we stress it, we go from 20.3 on the net to investor IRR down to 19. And then we can go back and see, well, what's the impact? Well, now after the 5th month or the 9th month, you're no longer at 5% like you were before. It's now dragging on all the way to, drag this over, you're now dragging on to almost 15 months. So we added a 6-month contingency, 6 extra months to get to fully stabilized on this property. The other thing to take into consideration on rents is not just time, like we did with construction, but also revenue. So the same way we looked at construction costs going over, we look at rents. Are we able to achieve the rents that we like on this property? Now, it just so happens this asset happens to be very close to the beach. So when we looked at, what do we stress rents to, we basically said, well, if the water's here and we're right next to the water, what if we're this far away from the water? So we compared coastal rents to inland rents. And it's about a 10% impact in terms of revenue. So on our revenue numbers here, we have our total square footage and we have the total expected rents. And here where it says, are we stressing the rents? It's a no, but we know that the discount applied to it is 10%. And so if I go to my pro forma now and I do rent discount, stress test it, my return goes from 20.3 to 15.7. So a 10% reduction in rent is significantly impactful to the financials of the deal, because it not only impacts your rents on day one, but it also impacts the gradual increase of revenue over time through your rent increases. So now you see that these rents are now tested and that the 10% adjustment reflects. So instead of 39,000 in aggregate on this project, we're only bringing in 35,000 in rents. So that's basically what the impact is on rent discount. So now we've kind of addressed, the construction window, the rental window, but we talked a little bit about like once the units are rented out, like the annual increases or the rent growth. And we talked about that we set it to what is called the CoStar model. And the CoStar, it provides us the 10-year lookout. We build a table based on it. And basically our model feeds off of the data that they provide us. And so I think a lot of people in this space, once they have something, they're always relying on the fact that we will be able to get 3% rent on this project, no problem, no questions asked, without fail. And that might be true. When we look at CoStar though, they took a lower annual increase number. And so we said, we're gonna underwrite conservatively, even in a kind of, baseline scenario. And what would that look like? So we use CoStar's data, but if we stressed it and said, well, let's say we can only get 1% rental income every single month from the time that we're...
The growth on rental income.
Right, the growth on the rental income. So by stressing this, I set everything to 1%, and then I can see that the impact goes down to 16.1. And again, just like the rent discount, by reducing our revenue, it does have a material impact on the IRR. I'll reset this back to CoStar and then address exit cap. So when we look at exit cap, we always look at, what do we realistically think we can get for the property upon completion, upon stabilization, all the way out to 10 years. And so in this build out, we looked at a sale in year 5, and then our exit cap is based on the data that CoStar provided us. The question is, what if we can't get that? Well, then we stress it and we basically increase rates. So in an increasing interest rate environment, which when we did this deal, rates were a lot lower than where they are today, this is one of those stress tests that came to realization, at least right now. Likely that the rates are still high, 5 or 6 years from now. It's a question mark nobody knows the answer to, but we've assessed a high interest rate exit would impact the project in what way. And so when we stress test, we go from 20.3 down to a 13.5 net to investor IRR. So the high interest rates that we're talking about has a material impact on the deal. On this note, I think it's important to address the fact that sometimes when you're looking at deals are reliant on a sale upon completion. In order to hit a positive result, you must sell by the time you're done. What happens if you can't, right? What happens if we're in a high inflation environment, the economy's hurting, and you're just not in a situation that you want to sell? Well, so we look at that too, and we basically, as you can see here, our model goes out 10 years. The reason why we model things for at least 10 years is to solve for that issue. So in this 20.3 IRR assumption, we are looking at an exit to sale in year 5. Well, if we have to hold the project to year 10, I just changed that number to 10, and I can see my adjusted IRR is 14.4, which on a 10-year hold, we like that IRR net to the investor. That's a solid number on 10 years. Right. And so that effectively addresses what happens if we can't sell the project upon completion. So those elements that we addressed, I think they're pretty consistent in most of the deals that we do.
So walk somebody through, because this is, every time we are talking to potential investors, when we do this, this is where we see the, oh my gosh, this is cool. Now show what happens if all of these scenarios happen at one time. We're in kind of Armageddon scenario, and we know the majority of investors around us are losing money. They're losing their asset. Let's look at that scenario.
Yeah, so we compare this a lot to 2007, 2008. Not everybody, a lot of people lost money in deals because they didn't underwrite them properly. And so up until now, we've talked about every single potential one of the things happening, some in combination with each other, but most of it isolated. But to your point, what happens if all of it happens to us in the scenario where most people or a lot of people lost deals? So we look at it and we say, okay, let's stress every variable in this deal. So I'm going to stress the revenue growth. I'm going to stress the rents. I'm stressing our ability to qualify for the type of construction loan that we've secured numbers for. I'm going way over on construction, and I'm going to adjust the permanent financing. And that permanent financing stress test we didn't touch on, but that just means higher interest rate once we go to a regular mortgage. Again, my sources and uses are off, so I'm going to have to update it and add that $569,000 back in. And now I'm in balance. And basically I see if everything happens, full-blown what we call kind of like real estate Armageddon, instead of losing money, we're still generating a positive return net to the investor of 4%. So it's a lot less than in a base case scenario. But I think the key is here, this is an environment where most people are losing their money, right? This is an environment where a lot of people are having to go towards really, really crazy type of lending solutions, or basically having to liquidate. And in this scenario, we're still generating a positive return. And so even though it's not as high as what we originally wanted, I think it demonstrates that in the face of every single variable of adversity that can come to the project, it's still producing a positive result. What I will touch on is exit cap for the viewers that are watching the screen here. Everything has been stressed except for the exit cap. Remember, exit cap has to do with what you're gonna get upon sale. You wouldn't sell this property in a scenario like this. We would just hold on to it and let the rents roll. And so we're not gonna, exit this deal at this point in time.
So this is what makes our company unique. And one thing I'll also add is, for myself, Michael, and all of our partners, we have a lot of our net worth in these projects with our investors. And so when we're looking at new projects to invest in, we're also looking at it through the lens of, we don't want to lose our money. This isn't just about us collecting a fee and making money from placing dollars. We want our investment to do well with yours. So we're very strict on the projects that we move forward on. Now, there are some investors that we talk to that think we are too conservative. And that's okay. When it comes to investing, you want to make sure that the investment and the group doing it are very aligned with your goals and your expectations. So for some people, that might not be a good fit. For the investors that we do have, which is getting close to about 500, they appreciate that. They like that our money is in these deals with theirs, and that we look at them from a true conservative kind of underwriting standpoint. So if you want to get more information on what we're doing, feel free to schedule a call. You can speak to one of us directly, or if you just want additional information, you can let us know and we will send all of that over to you. And if this ends up being a good fit, we would love to have you partnering on all of our future deals.